Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Amanda Rebello, Managing Director at DWS Group and Head of XTrackers Sales. We're talking about investing in China today and about DWS's China ETF, ASHR, which has seen a lot of interest lately. Amanda, welcome back. Great to have you on the show.
Neena, thank you so much for having me back. It's a pleasure.
So China's economy expanded by 4.6% in the third quarter, and this was the lowest growth rate in 18 months and also short of government's full-year target of 5%. And there are so many other problems in addition to slowing growth. So according to Wall Street Journal report, there are 90 million empty housing units in the country, which is enough to house entire population of Brazil. And meanwhile, China's population has been declining because of their single-child policy over the past few decades. And their households have invested almost 80% of their savings in real estate. So many have incurred significant losses due to the real estate meltdown, and the youth unemployment continues to rise. And I read an interesting comment in the Financial Times recently, but it was by Ishwar Prasad, the professor at Cornell University. And he said the Chinese economy is caught in a doom loop with cyclical and structural problems feeding off and reinforcing each other. So I wanted to start off with your outlook on the Chinese economy. Mm-hmm. Is the economy caught in a doom loop?
So actually, we think not. We're very privileged at DWS. We have a fantastic APAC CIO, Ivy Ng, and then we also have a joint venture with Harvest Global Investors. It's one of the largest asset managers in mainland China. So they've I can't take credit for all of the points that I'm going to make today. They come from much smarter people than me. But one thing that we think is that you're absolutely right. The GDP growth has dropped off from China. But at the end of the day, it's still higher than what we have in the Western world. So when you're thinking about a portfolio, it still has a part to play. What we see is that actually the stimulus measures which came out, they started at the start of October, and China is going to make them work. So they have this target GDP growth rate of 5%. That was reduced maybe about 2-3 years ago from a GDP target growth rate of 6.5%. But like I say, that's still much higher than what we're experiencing in the US, for example, and in Western Europe. When we look at what the stimulus measures were about or have been about over the past couple of weeks, so every weekend, typically, more and more measures are being rolled out. It all kickstarted with freeing up bank balance sheets, basically. So what we saw was that 1 trillion yuan was freed up in terms of bank capital. And that's a hell of a lot, even when we think about it in dollar terms. There's about 7 yuan to every dollar. And that was done basically by reducing the reserve requirement ratio for bank balance sheets. So, the capital that you need to put aside versus what you lend. And then also reducing the 7-day repo rate. What we saw was that we have basically a consequence, which is then decreasing the mortgage rates for retail investors. So we always talk about commercial real estate, but this was actually for residential mortgages of 50 basis points. And that actually ended up then freeing up for the consumer, which is really what always we're talking about when we're thinking about China. 150 billion yuan. So that's really important, especially when you think about this is a population. At the end of the day, you can say the population is decreasing. We know that there's this aging population now, as you said, because of a consequence of the rollout of the one-child policy in the late 70s, early 80s. The population is still 1.4 billion people. So we don't need to worry too much about decreases.
So as you mentioned, about a month back, Chinese authorities had fired the stimulus bazooka. But this came after 3 years of limited support from policymakers, and the stimulus that set off an epic rally in Chinese stocks. And not only Chinese stocks, other sectors which are exposed to China, including copper, miners, casino companies, luxury good makers, European automakers, they all rallied.
Yes.
And there was a fear of missing out then. And billionaire hedge fund manager David Tepper, who is president of Appaloosa Management, he told CNBC that he has bought everything related to China. But we have seen that since then, over the past few weeks, stocks have slipped. So it seems that investors are slightly skeptical whether these measures will be enough to prevent the economy from slipping into a deflationary spiral. So do you think these measures are enough to revive the economy? And also, do you think they will announce more measures in the coming months?
Yeah, great question, Nina. So I think, when we often look at the CSI 300 because really this is the index, which is like the S&P 500, what retail and institutional investors in China are buying, and using as the benchmark for large cap equities. What's really important with China, just before I go into answering your question in more detail, sorry to be an index nerd, but, you have to think about which index you're looking at when you're looking at China. And the CSI 300 is really important because, first of all, the A-shares market is the one to look at when you're looking at China. You've got the H-shares, which are the Hong Kong listed stock. You've got the ADRs, which we see like Alibaba, for example, on NYSE. But really A-shares, it's the stocks which are relevant for the two main exchanges in China, the Shenzhen Exchange and the Shanghai Exchange. So first of all, looking at A-shares. If you then look at CSI 300 versus an MSCI A-shares index, for example, it's also the one which is more representative of the genuine, large cap equities in China, and then also, what the reference is for that market. And China, like the US, has a home bias. So, it's always best to look at the biggest buyer of China and Chinese equities is China. So use the benchmark and reference the benchmark that they're looking at. When we look at the levels, you're right, there has been a dip over the past couple of days. But what we saw was that it was incredible. The CSI 300, it rallied from around in mid-September, which was kind of the low for the last 12 months. It was at 31.59. And the peak was at 42.56. That was at the start of October. And we're now at 38.90. So even from that high that we saw at the beginning of the month, it only dipped 8%. That's not really terrible in light of the gain that it's made. Nina, you raised a great point. Like, can we expect more? Absolutely, we can. China is one of these countries where, if it says it's going to do something, it does something, right? We see this incredible mobilization from the Chinese government, from the People's Party, that they can mobilize these 1.4 billion people, when they want something to get done. And I think one thing that was really interesting is what we're kind of going to expect, and what Ivy, our APAC CIO, has identified is, if you think about household spending, so Nina, you raised a great point about the aging population. Elderly care and the cost of elderly care is a real thing for Chinese households. I think some people in the audience might know that there's this situation where Chinese families, they provide care, or to the generation above. It's while it's a socialist country, really a lot of care will be provided by the family, or they will support the cost for elderly homes and things like that. And so one of the measures that is anticipated is that there will be a big reduction in this cost. What it means then, in addition to the fact that now mortgages have also decreased as well in that kind of monthly outgoing, that's more money for spending. And one of the interesting programs which is also anticipated is a trade-in program, a new for old. So you have an old Huawei phone, you can buy a new one at a discounted rate. You trade in the cost and then you don't have to pay the full cost, right? Things like this. So all of these different stimuli, which will also be targeted on, goods which are produced in China. That's what we're expecting. And this is what will ultimately boost the consumer spending, which is probably the number one question mark that everyone has around China.
So we have an election coming up next week, right? So let's talk about the implications of the US election on China and investing in China. So Trump plans to increase tariffs on Chinese goods by at least 60%. And the Biden administration hasn't exactly been friendly towards China. They severely restricted Chinese access to advanced American technologies, particularly cutting-edge chips. And that policy may continue under Harris. So it appears that regardless of the election outcome, China should expect a more challenging political environment. So I was interested in your thoughts on implications of the US election on China investing.
Yeah, I mean, we're all thinking about the what ifs of the election this week, and China is definitely one of them. I think all of us know that regardless, and it's something that, we at XTrackers have been speaking about for pretty much over a year. We launched this product, CRTC, the US National Critical Technologies Fund, in November last year. It's coming up to its 1-year anniversary. And we've always been known for this China equity product that we have, ASHRs, but then we're also very aware, we're very privileged to have these conversations with clients that there are a number of investors who do worry about intrinsic exposure to China through supply chains, which will then suffer from tariffs. I'm not sure if everyone knows on the call, but just want to remind everyone that the tariffs are also working in the reverse direction as well. So we do see there are Chinese tariffs on US tech as well. A great case in point, also not really a tariff, but policy. The party members are not allowed to have an Apple iPhone, for example. And when that was rolled out, you ended up seeing $300 million come off of Apple share price or market capitalization. So it's also happening in the opposite direction, Nina. And we also just saw as well, seems like something very small and trivial, but it's not when you think about some of the consumer habits. But China just a few weeks back also put a tariff on European brandy as well, for example. So they are utilizing tariffs in the same way that the US is utilizing tariffs to stabilize or to send messages to different markets. The broader theme we're really aware of as well is like reshoring. So we all saw in the pandemic that, we had furniture being built in China, for example, and then it's then taking a very long time to make its way to the US. I think West Elm revenues ended up going up higher than they had anticipated as a result of this because all of their production is in the US, for example. But just going back to this tariffs piece, either way, deglobalization, not just for China, but also for other countries that are heavily reliant on supply chain, is a real thing. What we do think about China, though, is that, like I said, they still have this 1.4 billion population. And even if it slides 10% over the next 5 years, that's still then, still over 1 billion, right? So still 3 times larger than the US population. Other things to consider as well, Nina, are that, when we look back to the start of the 2000s, the GDP contribution globally of the US was something like around 23% versus for China, it was just 3%. And if you look at the 2023 figures, these come from the IMF, the contribution of the US GDP to the global GDP fell to 23%, and then China actually caught up and then made it up to 17%. So you also need to think about these relative kind of components of GDP contribution as well. And all of the countries are putting tariffs on to kind of try and stabilize or increase their contributions to the global GDP this way.
So you mentioned some good points, and I wanted to talk a little bit more about the longer-term bull case for investing in China. And we know China is the world's second largest economy and home to many very innovative companies. And the country is a leader in areas like electric vehicles, autonomous vehicles, self-driving cars, solar panels, drones, etc. And Chinese stocks are cheap, particularly compared to the US stocks. In fact, the MCHI China index that currently trades at about just 15 times next 12 months earnings. That compares to about 29 times for the S&P 500 index. So almost half. But maybe these stocks are cheap for a reason. And if I look at the performance of Chinese ETFs, they have gone nowhere in the past 10 years. In fact, when I look at the performance, your fund, ASHR, that has done best. That is up about little more than 54% over the past 10 years. Whereas the other popular China ETFs, like the one by CRTC and by iShares, KWEB and FXI, they have basically gone nowhere. So that's 10 years of dead money, whereas the S&P 500 index has surged almost 250% over the past 10 years. And then, in addition to these political worries that we discussed, there are geopolitical risks, particularly regarding Taiwan. And then many investors believe, and they rightly believe, that some of the biggest US companies, they already have a lot of exposure to China. For example, Apple, they get about almost 20% of their revenue from China. For Tesla, it is about 23%. And these are the companies that most investors own in their portfolios, either directly or through their S&P 500 funds. So investors believe they are getting some exposure to China. So why should we invest in China? Why should we look at China ETFs? I would love for you to talk a little bit more about that.
Yeah, thanks, Nina. Some great statistics that you put out there. So I think, in terms of performance, like none of us can compare anything to the S&P 500. Like nothing is going to beat it, basically, from a risk return perspective. So,
right.
But I think absolutely, like for us, the story with China is always about diversification. So what we feel is that, like I was talking about, this contribution to global GDP, I think none of us would say that, we have an allocation to China in our portfolios, which is really representative of its exposure to its contribution to global GDP. Other things, when you think about it, the market cap of China is about an eighth that of the US. And so even if you think about if you have a market cap weighted exposure kind of basket of equities, do you have the right exposure to China? I don't think any of us has an allocation which is an eighth of, a US equity exposure. And granted, we would have some home bias because we're all here based in the US. But even then, I think we're not quite where we need to be. So we think it makes sense to make an inclusion on that basis, just to be also thinking about the future as well, when we look at the trends in terms of market capitalization growth, also the GDP contribution. So we think China makes sense there. It is working as a diversifier, so it's only, I think, 60% correlated to US equities, so worthwhile from that perspective. And I think all of us are wondering, when is the top of the market? So diversification, while it's been very good to be very long and maybe overweight US equities, US large cap in particular, we on the XTrackers side and DWS side are thinking it makes more sense to rotate some of that maybe back into into international equities, DM and EM. One thing that we were just at a conference last week and discussing very heavily, everyone has this very long exposure to the Mag 7 at the moment. So what you find is actually, if you've got a 60-40 portfolio, and you think about your US equity exposure within that equity exposure, about 40% of your risk is allocated to just 7 names. And I don't think any of us intend this. So just something to consider. China could be a good diversification tool from that perspective. Nina, I loved your point about how we all have exposure to China, whether we know it or not. And this, we talk a lot about EMX China, but really we need to think about DMX China. And again, that comes back to this CRTC fund that we've launched, which is about having an exposure to national critical technologies defined by the DoD, which are really technologies, not just defense technologies, but technologies more broadly, which are aiming at maintaining and enhancing the US economy on the global stage. What you also do then is that you have this overlay, which is a geopolitical, geostrategic risk rating applied to every single one of the stocks, which are within that universe. And it's about their exposure, high or low, to adversary nations from a US lens of China, of Russia. We know what's going on in Ukraine at the moment. North Korea, Putin has just now has North Korean troops on the Ukrainian border, and Iran. And we know about the situation with Iran and influence in the Middle East and in the Middle East conflict. So there are ways, if you do want to think about DMX China and USX China, then we can also help from that side as well.
Excellent points, Amanda. Let's talk a little bit about your ASHR ETF. And you mentioned the Chinese equities, the alphabet soup. You mentioned some of them. There are many differences. Yeah, there are many differences in the ways you can get exposure to Chinese equities. So there are A-shares, H-shares, N-shares, and there are P-chips, red chips, and then ADRs, which are listed in the US. So your ETF, ASHR, I believe this was the first US-listed China ETF that provided exposure to China A-share market directly. So could you talk a little bit about this ETF and the kind of interest it has seen from investors lately, and why A-shares in particular investors should look at?
Yeah, thanks so much, Nina. That's so kind of you to highlight. Exactly. We were the first A-shares ETF in the US domicile space. So we're delighted to be able to be a first to market on that side. Our collaboration with Harvest continues. So back in those days, the fund was launched in 2013. You needed to partner with a local asset manager at the time to have access to what was called an RQF status. So basically a registered qualified foreign investor, institutional investor. The regulation then changed to this QF status instead. And then we've now moved to a situation of the Connect program. So basically, Western asset managers can actually now just directly access themselves the stocks which are listed on the Shenzhen exchange or on the Shanghai exchange. We are still committed to working with Harvest. And the reason why is because there are still nuances in the Chinese market, like things like stock suspensions. Obviously, there are different holidays and things like that. And, there are specialist brokers for Chinese equities at the end of the day. And so working with a local partner can really help us too. When we're building index ETFs, we are always looking to, we talk about alpha a lot, obviously, on the active side. But, we really want to provide as tight tracking as possible on our index products. And working with Harvest is helping us to do that, just because they have that on-the-ground experience. One thing to note as well is that Harvest is Beijing headquartered. So there is still a distinction between mainland and Hong Kong, and it's something to consider. And that then leads me to the point about the Hong Kong listed stocks versus the Shenzhen and Shanghai listed stocks. If you think about it, if the primary listing is Shenzhen, Shanghai, then it means that you can capture all of the Chinese stocks and companies. Not all of them will have a Hong Kong listing. Not all of them will have an ADR. So it also gives you access, if you take the A-shares approach, to really being able to, gain the full access from a sector perspective, from a company perspective. It's really the way to go.
Excellent stuff, Amanda. We'll have to leave it there. Thank you so much for joining us today and for sharing your insights.
Thank you for having me. It's been a pleasure.
That was Amanda Rebello from DWS. So she talked about the China A-shares ETF. The ticker symbol is ASHR. It is XTrackers Harvest CSI 300 China A-shares ETF. So as the name suggests, it provides exposure to 300 largest and most liquid Chinese shares traded on the Shanghai and Shenzhen exchanges, China A-shares. And she also mentioned the XTrackers US National Critical Technologies ETF. The ticker symbol is CRTC. So this provides exposure to developed market DM equities, which are in sectors vital to maintaining US national security. So obviously you'll get a lot of exposure to stocks like Nvidia, Amazon, Alphabet, Microsoft, etc. Now, there are some other China ETFs also, which are quite popular. And these are different ways of investing in China. So if you're interested, you can look at the Crane Shares CSI China Internet ETF, the ticker symbol KWEB. This provides exposure to Chinese internet companies, which are listed on the Hong Kong or US exchanges. And then there's the iShares MSCI China ETF, ticker symbol MCHI, which provides exposure to multiple classes of Chinese equities that are available to international investors. And this includes H-shares, B-shares, red chips, P chips, and foreign listings. And if you want to avoid China altogether and still want to invest in emerging markets, then you can look at an EMX China ETF like the one by iShares. The ticker symbol is EMXC, iShares MSCI Emerging Market ex-China ETF. This has seen a lot of interest from investors this year. And obviously the top holdings in this ETF are Taiwan Semi and Samsung and HDFC Bank. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.